Here's a number that should be on every investor's radar right now: 2.4%. That's the latest CPI inflation reading for January 2026. Sounds great, right? We're almost at the Fed's 2% target. Inflation is cooling. The economy is growing. Stocks are near all-time highs. But here's the thing. Underneath that headline number, there's a completely different story playing out. And if you don't understand what's actually happening with interest rates, inflation, and the job market right now, you're going to be caught off guard by what's coming in the next 3 to 6 months. So let's break it all down. No speculation, no drama, just the data and what it actually means for your money. Alright, so the Bureau of Labor Statistics released the January 2026 CPI report on February 13th. Headline inflation came in at 2.4% year over year. That's an 8-month low. It dropped from 2.7% in December, and it came in below what economists expected. They were projecting 2.5%. So what's pulling inflation down? A few things. Energy prices fell 1.5% in January alone. Shelter costs, which make up over a third of the entire CPI basket, rose just 0.2% for the month, bringing the annual shelter increase down to 3%. That's a big deal because shelter has been one of the stickiest inflation categories for years. Food prices were moderate too, up just 0.2%. Oh, and egg prices down 34% over the past year after that crazy surge. So your breakfast is finally getting cheaper. But before you pop champagne, look at what's happening underneath. Core CPI, which strips out food and energy, actually accelerated to 0.3% month over month. That's a 5-month high. Airfares jumped 6.5%, the steepest gain in nearly 4 years. Sporting event tickets surged 5.4%. Parking costs shot up 7.4%. So the headline looks great. The details, more complicated. As one economist put it, the spreadsheets look cheery, but households still aren't feeling the relief. And that tension between the headline number and what people actually experience is exactly what makes the next few months so interesting for the Federal Reserve. Now let's talk about the other half of the Fed's mandate: employment. The January jobs report dropped on February 11th. The economy added 130,000 jobs. That beat expectations by a mile. Economists were forecasting just 75,000. The unemployment rate ticked down to 4.3% from 4.4% in December. Sounds solid, and it is. But context matters. Here's the number that doesn't get enough attention. Job gains averaged just 15,000 per month in 2025. That's after the BLS revised the prior year's data, down by 862,000 jobs. So the labor market was much weaker last year than we originally thought. January's 130,000 is a huge improvement over that pace, but the gains are heavily concentrated. Healthcare and construction are doing the heavy lifting. Meanwhile, federal government jobs and financial services actually lost positions. The broader picture is a labor market that isn't falling apart, but isn't booming either. Long-term unemployment, people jobless for 27 weeks or more, is up by 386,000 compared to a year ago. Wage growth is slowing, which is squeezing household budgets that are already stretched thin with elevated debt levels. Weekly jobless claims did fall to 206,000 in mid-February, which is a solid number. But the labor market is essentially in a holding pattern: slow hiring, slow firing. And that's important because the Fed needs to see one of two things before cutting rates again: either inflation clearly heading back to 2% or the job market weakening enough to justify support. So where does the Federal Reserve stand right now? On January 28th, the Fed held interest rates steady at 3.5%. This was expected. It was the first pause after 3 consecutive cuts in the second half of 2025 that brought rates down from their peak of 5.25%. The vote was 10-2. 2 governors dissented and wanted a quarter-point cut. Fed Chair Jerome Powell said at the press conference that policy is appropriate right now and that the economy is on firm footing. But here's what the FOMC minutes from that meeting revealed. And this just came out this week. A majority of policymakers are worried that getting inflation back to 2% might take longer than expected. Some even floated the possibility that rates might need to go higher if inflation stalls out. So the Fed is in no rush. The next meeting is March 17. According to the CME FedWatch tool, there's about a 94% probability that rates stay unchanged at that meeting. Almost no chance of a cut. The meeting after that is May 6 a year. Still very low odds of a cut. But here's where it gets interesting. By the June 17th meeting and beyond, markets are pricing in a much higher probability of rate cuts resuming. Bankrate projects 3 cuts totaling 0.75% in 2026. Goldman Sachs expects 2. The Fed's own dot plot suggests at least one more cut this year. The most likely timeline based on current market pricing. The first cut comes around mid-year, June or later. Now, one wild card. The Fed's leadership is changing. Powell's term as chair expires in May. A new chair will bring a new approach. Some FOMC voters this year lean more dovish. Wells Fargo's analysis shows the new voting roster is made up of 4 neutral voters, 6 dovish voters, and just 2 hawkish ones. So the second half of 2026 could look very different from the first half in terms of monetary policy. Okay, so we've got cooling inflation, a stable but not great job market, rates on hold for now, but cuts likely coming mid-year. What do you actually do with this information? Let's go asset by asset. Stocks. The S&P 500 briefly crossed 7,000 earlier this year and is currently hovering around 6,850. It's up about 12% year over year. Wall Street consensus expects another 12% gain in 2026, with Goldman Sachs and JP Morgan both in that camp. S&P 500 companies are reporting Q4 earnings growth of about 13%. That's the 5th straight quarter of double-digit growth. Revenue growth is running at nearly 9%. Those are strong numbers, but here's the caution flag. Valuations are stretched. The forward PE ratio is around 21.5, which is above both the 5-year and 10-year averages. The CAPE ratio is in territory only seen once before during the dot-com bubble, and there's a notable rotation happening. From October 2025 through February 2026, the leaders have been gold, biotech, energy, and materials. The laggards, high beta tech names. Several of the mega-cap tech stocks have actually underperformed while defensive and commodity sectors have led. Rate cuts, when they come, will generally be positive for equities. Lower borrowing costs boost earnings, increase consumer spending, and make stocks more attractive relative to bonds and savings accounts. But if you're concentrated in expensive growth stocks, a rate cut alone might not save you from a valuation reset. The opportunity here might be in sectors that directly benefit from falling rates: financials, increased loan activity, real estate, and companies with strong fundamentals that have been held back by high borrowing costs. Bonds and fixed income. JP Morgan strategists point out that as the Fed approaches its neutral rate, longer-term bonds are becoming more attractive. The yield curve is steepening, which means there's an incentive to move out of cash and short-term instruments into longer-duration bonds. If you've been sitting in money market funds or high-yield savings accounts earning around 4 to 5%, the time to start thinking about locking in longer-term yields is approaching, because when cuts actually start, those short-term rates will drop. Mortgages and real estate. The 30-year fixed mortgage rate just hit 6.01% as of this week, the lowest since September 2022. That's down from nearly 7% a year ago. Refinance applications have more than doubled year over year. But lower rates don't automatically mean cheaper houses. If mortgage rates drop further, more buyers enter the market, which can push home prices up. Experts project rates bouncing between 5.7 and 6.5% throughout the year. Gold. This is the standout story of 2026 so far. Gold hit an all-time high of $5,594 in late January and is currently trading around $4,952 per ounce. That's up over 70% in the past year. Central banks, especially China and India, have been buying aggressively. China's central bank has purchased gold for 15 consecutive months. Gold benefits from 3 tailwinds right now: persistent demand from central banks, diversifying away from the dollar, expectations of future rate cuts which lower the opportunity cost of holding gold, and elevated uncertainty. But after a run this big, expect volatility. Gold pulled back from its highs and is in what analysts call a digestion phase. If you're looking at gold, think of it as a long-term diversifier, not a trade you chase at the top. So let me tie all of this together for you. We're in a window right now where the data is sending mixed signals. Headline inflation looks good. Core inflation is sticky. Jobs are okay, but not great. The Fed is on hold. Rates will likely start coming down mid-year. For investors, this means 3 things. 1. Don't sit on the sidelines waiting for the perfect entry. Markets have historically rewarded people who stayed invested, and dollar cost averaged through uncertainty. 2. Diversification matters more than ever. The stocks leading the market today are not the same ones that led in 2024. Gold, energy, healthcare, and financials are having their moment. A concentrated portfolio in one sector is a gamble, not a strategy. 3. Watch the data, not the noise. The February CPI report drops on March 11th. The next jobs report is March 6th. The next Fed meeting is March 17-18. These 3 dates will set the tone for the rest of the first half. Put them in your calendar. That's the state of the economy in February 2026. No narratives, no spin, just the numbers and what they mean. If this helped you see the bigger picture, drop a like, subscribe if you want breakdowns like this every week, and let me know in the comments what's your biggest question about the economy right now. I'll see you in the next one.